All right, so up next, we're getting into the deep capital markets conversations. All right, usually I try to flesh this out with a bunch of different brokers. Not this year. This year, we're talking to people who are executives in the capital market space, who are entrenched in both the technology and the politics of capital markets, as well as having emotional relationships with those who have money and can give us sentiment on where investors are thinking. So, without further ado, let's introduce Thomas Sherlock, CEO of Talinvest, and Charles McKinney, CEO of Vontive. All right, guys, thank you both for being here. So this is always my favorite session because anything that's just numbers is a good time to me. But sometimes numbers are hard to follow. So we're going to try to keep this as human level as we can. So Thomas, I'm going to start with you. You spent 7 years as an iBanker in commercial real estate. You saw the RTC crisis in the 80s. You built a credit program for Citibank, a commercial real estate credit program for Citibank. You worked for a Fortune 500 company that imploded within a year. And from that, you were one of the founding partners of Buchanan Street Partners, which is a very successful capital markets business. And in 2010, you left to start Talinvest, which is what you're doing now. And you are talking to equity, you're talking to debt, you're talking to not just investment managers, but family offices, high net worth individuals on a regular basis for a large multitude of clients. Like I said, let's start with the human side. What is the primary emotion and like inner dialogue of those that have money and want to place it? Like what is everyone saying to themselves when they're not putting on face for others?
What they're saying is, I'm nervous right now.
Okay.
There's trepidation in the market. That's what thank you for the nice introduction. What it really means with all of that information is I'm old and I've been in the business for a long time and I've seen a few things. Where we are right now is a place we haven't been for a while. Everybody is waiting for something to be better, but they're not quite sure what that something is. So the emotions are really kind of bouncing up and down and up and down, and we're seeing that in the treasury market. You know, when you look at cost of capital, where's the treasury yield trading? Well, it was 350, then it's up 490, now it's 410. So just that volatility is making everybody anxious. I think that's the big takeaway right now.
And is the anxiety just about looking at charts? Or is it this like fear that they're going to be the one that gets it wrong? Like where does the anxiety come? Because there's so much opportunity still, right?
Yeah. I think there's two things going on with the fear. One is when I've talked to some of the chief investment officers at some of the institutional investment firms, they'll ask, what do you think's going on? How do you see the market? We talk about that. And I've shared with them, hey, I feel like we're turning up from the bottom. And I can't point to a lot of things that technically support that, but you can sort of feel it. When you've been around a while, you can sort of feel it. And there's enough things that have been changing, and some of the things are capital providers, lenders, who are saying they want to do more business, banks who feel like they've gotten healthier over the last couple of years. But the CIOs at these institutional investment firms were saying to me, Tom, yeah, I think you're describing it accurately, but here's the thing. We've bounced along the bottom for so long. I don't want to buy when we're just on a tick up. I've got to see some sustainability to that. I've got to see a couple of quarters of sustainability in that bounce up. Otherwise, I might look like a knucklehead to my investors, and I don't want to do that. So yeah, I'm excited, but I'm waiting, you know. And there's that anxiousness. If they buy something, they don't want to look foolish. If they don't buy something, they don't want to look foolish. That the trend is really just going up. So it's kind of an odd time right now.
So I want to juxtapose where we're at today with the experience that you had during the GFC, Charles. But before we get into that, can I ask a favor from anyone in the back that's able to close the doors for us so that we can have the level of intimacy and respect in this space as we are looking for? So Charles, after getting your degree in anthropology, you worked at McKinsey and KPMG and then did consulting and eventually landed at Freddie Mac, where you had working on the affordable housing strategy until 2009. But then you were doing workouts and strategic development for directing loans to special servicing, loan programs, RE dispos, all the REO stuff post GFC, which is just a really interesting vantage point. That's before being an executive at 10X, before building your financial tech platform that you have today, which is Vauntive. Let's start with the GFC, if that's okay. What Tom just said about anxiety in the marketplace today, how does that compare to what you saw from your vantage point in 2009? I already know the answer, but I'm just curious, just to start the conversation. What's the difference between the two? Is this the same thing? Is it completely different? Frame it for us.
So I'll start by saying I have a very different point of view on the markets with the people I talk to. We can come back to that.
Okay.
I actually think that there's a real focus on relative value, and it's a quantitative exercise for institutional investors versus I want to look like a fool. So following the great financial crisis, there was a reset period in 08 through 09. And then at that point, if you're in real estate, especially in single family, you saw a combination of like local investors come into the market, and you also saw institutionally backed, private equity backed startups come into the market. You know, some of those are now large publicly traded businesses like Invitation Homes. And I think that, you know, we as early as like the middle of 2009 had institutional folks coming and wanting to buy up like large REO portfolios, for example, and they were aggregating things at the foreclosure auction. So I think there was a very strong commercial orientation following 08 that if you could raise capital and you had an investment thesis that made sense, you could go into the market and make a lot of money. There was a lot of cheap assets. Things aren't cheap right now. I think if you look at you know, bond spreads, for example, if you look at investment grade corporate debt spreads, they're at a 27-year low. Now, I think there's still demand to invest in corporate debt. There's still demand to invest in real estate-backed bonds because while the spreads are tight, the benchmark rate, whether it's the, you know, depending on where you're at on the I curve, is relatively high. So you can get, you know, with 20% credit support, you know, like a high single digits, mid single digits to high single digits return. So that's pretty attractive for bond investors looking for duration. But I think things now are, you know, are much more expensive than they were through 2012, 2013, 2014. And then to, you know, echo what, you know, Tom was saying, you know, we're also in another reset period. So we've seen the Fed raise the funds rate to 5.5. Now it's at a target of 4.5. The effective Fed funds rate is at 4.3. And we're seeing Trump come in and do structural change, largely in part to correct the budget deficit and the debt level of the United States government, which we can't sustain. I think everyone agrees. And so it's interesting. Where we're at now, I think, is very different. That said, I think with the Fed backing off, I think there's a lot of opportunity to create alpha. And if you look at hedge fund performance, you know, some people are very successfully doing that.
Take that back to your first sentence, which is, I think there is interest from capital to get playing today.
Well,
tie that, like, okay, there's opportunity to get alpha.
Yeah. So I think that...
And define alpha for the audience, please.
So in investing, alpha is, you know, you're making an investment, you create value. Beta is risk. Think about beta as the standard deviation on price change in an asset or stock over time, something like that. When the Fed was dominating the market through the zero interest rate environment, it was very hard as an institutional investor, hedge fund, et cetera, either at the equity level or the debt level, to go in and, you know, really affect achieve a result that would be better than the S&P 500, or that would be better than, you know, a kind of a general bond index, you know, that you might benchmark yourself to. That's changed. Over the last couple of years, you know, that's changed, and I think it'll continue to change, you know, especially as we see...
In which direction? You think it's easier to beat the S&P 500?
I think smart capital allocators, it's easier to do that because you don't have the Fed dominating everything.
Okay.
And we're in a period of structural change and structural uncertainty. When you're in a period of relative stability, a cyclical period, models work. When you're in structural change, models don't work, and so it just creates more opportunity for for investors to go in and find strategies, develop strategies that will beat the market. Not everyone will do that, but I think the probability of doing that, the probability of saying, hey, my 1-year return is 25% better or 50% better than the S&P 500, more people will do that now than they would have, say, 2 years ago or back to 2015, 2016.
Interesting. Tom, I'm going to fish for a different opinion here. Like margins and spreads with banks, like interest rates are above cap rates. Is this something that you're seeing as well?
Well, I want to go back to something
Yeah,
Charles
sure.
said, because
Yeah.
I agree that there is a tremendous amount of opportunity in the market right now. I think there's a lot of opportunity. I think it's hard to get people comfortable even when they pull the trigger.
Specifically capital sources.
Specifically capital sources. That includes equity investors as well as lenders. I was
And let's frame it. This is capital sources putting money into operators, not putting money into their own internal balance sheet transactions.
Putting money into operators' deals.
Yes.
Yeah.
Yeah.
So whether that's banks, life companies, debt funds, credit unions on the debt side, whether it's an institutional or investor or a family office putting money into a development project on the equity side, and all of the above. I think there is I think it's fair to say that the debt side of the equation is much healthier than it has been for the last couple of years. I actually was talking to a gentleman who runs the Western U.S. for one of the big 5 banks in the country, and I've known him for a long, long time. And he was telling me a story. He was on a panel with 2 developers and a workout specialist. And he was laughing. He said, Tom, I was the most optimistic guy on the panel. How many times has a banker been on a panel with 2 developers and I'm the leader of optimism in this group? But he was talking about it wasn't because they were pessimistic. That's how optimistic he was from the bank side. We spent the last 2 years fixing our problems. We're chomping at the bit to lend money. Now that was his perspective, and I think there's a lot of truth to that. And I think it runs across the debt spectrum. There's a lot of lenders who want to put capital out, but, and this is the big but, it's not like it was 3 or 4 years ago when nobody thinks about risk. It's all about, I just want to lend money. Let's go. How much volume can I do? Right now, credit officers, the credit side of the lending institution has a lot of influence, has a lot of power. And in some ways, they're picking the wings off a fly sometimes with their underwriting. It gets pretty granular, and the deals are still getting done. Don't get me wrong, the deals are still getting done. But man, you got to be ready to slog through the mud to get them done sometimes.
So here's a question for you, Tom, and I'm really curious about your opinion too on this one, Charles. I don't usually like to double tap on the same question, but I'm curious about the opinions here. Yeah, it took me a while to learn that when you're getting a loan from a bank or from anyone, it's not just run some math, check, yes. There's a human emotional interaction. And so understanding the needs and the concerns and the lived experience of these originators, these bankers, these credit folks, these risk folks is important to feel like you're in a collaborative relationship. So what has been the problems of the last 2 years that these folks have experienced? What's been their lived experience with auditors and regulators? What have they gone through?
Well, you touched on one, regulatory pressures. When interest rates moved the way they did, it put massive pressure on bank balance sheets. Basically, their balance sheet was upside down. So they were dealing with
What does that mean, like negative equity in the bank?
You bought treasuries at X and they were worth 1/10 of X on the balance sheet. And it was because interest rates had shot up. That led to, oh my gosh, we've got to demand deposits. So if we're going to make a loan to you, I need 25% of the loan amount back in deposits in my institution. We literally had a lender who said, I'll make you a loan and we want 100% of the loan amount in deposits. I'm like, that's a business model right there. Yeah. That's profitable right there. But that's how bad it had gotten. So it was almost, if you put yourself in that person's shoes, as opposed to the normal economic environment which says, I want to find good transactions, whether I'm a lender or an equity investor, I want to find good opportunities to invest in. And that's how I stay employed, because I'm generating returns. It became, I'm nervous about doing something because if it goes bad, I might lose my job. But if I don't do anything, it's okay because there's not a lot of volume going on. I'm not at risk of losing my job. That's a weird, unusual dynamic. It's only happened a couple times that I can remember in my 40 years in the business. But that's where we were. It's not where we are now.
Awesome.
Not
So
where
now
we
we
are now.
understand the emotional experience of those that we're interacting with. Charles, do you have any insight into?
I don't think banking and lending are emotional whatsoever.
Okay. All right. Hit us.
I don't think they're emotional. So first of all, I think and you can look at call report data on banks to empirically kind of tabulate or show what I'm about to tell you. Certainly, investments in mortgage-backed securities, not treasuries per se, it was more of an MBS problem. You had mark-to-market markdowns, and that did bring in OCC, thrift supervision, et cetera. But at the same time, the banks had a big run-up in deposits post-COVID, and the bank regulators have had to acknowledge that they put pressure on these financial institutions to lend the money out or to invest it. So it was, they were like, go buy mortgage-backed securities, et cetera. And so there was a bit of like complicity in, the situation around mark-to-market, but that's a tangent. With regard to lending and, the experiences that I've seen over the past few years, I think it's very sector dependent. So we focus on single family, 1 to 4 unit, and we focus on small balance multifamily. We've stayed away from commercial just because I'm not a commercial guy. I don't know how to underwrite single tenant occupancy, things like that. What we have found is that from banks and from private credit especially, there is massive demand right now, massive demand to come in and get exposure to the full spectrum of real estate-backed credit. I'm not talking about multifamily here because of some of the problems that we've talked about, cap rates being less than, interest rates you'd refinance at. But on the single family side, I think there's pretty strong buy-in now to, the shortage of affordable housing, to the age of the housing stock. And, I'll give 2 examples. There's a large asset manager, Pretium, that we have a relationship with. They just announced a $5.5 billion fund to back single family residential construction. One of the investors in my company is Citibank. We'll be announcing this publicly in a few weeks. And they're getting ready to do, lending around construction and whatnot that they haven't done since before '08.
Heard it here first, folks.
Yeah, so, and that's in the press. I'm not saying anything confidential, but, but look, 2 examples. And I think that, really, if you're an investor looking to put capital to work, and I'll focus on the kind of the debt spectrum of the capital stack, you're looking for relative value. People have been big investors in, in investment grade corporate debt, in, triple B, B minus, even junk debt. Spreads are very tight. They've compressed a lot. And so people are looking for relative value. And I think that's going to be the play over the next 12 to 24 months. I also think that investors, to your point earlier, I think where fear and anxiety does show up is how do we react to what's going on in a macro environment that is turbulent? Like an analogy that I would use is we're all getting on a roller coaster, or we're sitting on a roller coaster right now. It can go different ways, the cars can turn and everything. We should be fine at the end, but you're going to go through a bunch of bumps and things that you don't know about to get there. And I think Tom makes a really good point about fear and anxiety. My perspective on that is the fear and anxiety really emanate from uncertainty around what's going to happen at the political level with government spending. I think the deregulation trends are going to be massively beneficial for both commercial and residential real estate. And look, I think the Fed's probably going to have to cut rates starting in no later than June, just given some of the shock that we're going to see around tariffs, like one-time price bumps versus, sustained inflation. I think the Fed's going to probably have to come in and start cutting, let's say by the end of the summer.
Okay, interesting. Cutting interest rates in response to inflation.
Yeah. Well, I think it's in response to the economy slowing. Look, the way to think about tariffs is it's a one-time price bump. Tariff goes in, you get that price bump. Unless there are reciprocal tariffs that keep happening and happening, it shouldn't really change the trajectory of inflation. And many bankers have written about this. You go read Barclays' research on it, for example.
Thesis, right?
Yeah, exactly. So I think you're going to see it's kind of like this, and it's this. But look, core PCE was 2.6 annualized year over year as of last Friday. Governor Waller has even come out and said he thinks the Fed is going to begin cutting by July. So I think that we're going to see, again, it's a complex environment, but we're going to see things that present tailwinds, the Fed eventually resuming cuts, deregulation, et cetera. And we're also going to see some headwinds, tariffs, economic uncertainty, political uncertainty, et cetera.
Okay, so since you've invoked the administration twice, I want to get Tom's opinion, see if there's any differing opinion here, or if you would double down on some of these things. How do you feel like some of the policies that are being talked about and executed on might affect opportunities for GPs in this room, mid-market folks, to interface with any type of capital in the stack, whether it's debt or equity?
I think it's very similar, our views on that. I think there's a lot in line there. I think from just from a commercial real estate standpoint, everybody frequently likes to talk about interest rates. What are rates doing? Where are they going? What are they doing? One, if I knew, I'd be a billionaire, and I wouldn't do what I do, I suppose. But there's enough things happening with the new administration that has some people concerned about inflation rates and a run-up in the long end of the curve, the 10-year, the 5-year money. And there's plenty of people who also feel that the Fed is going to be lowering the short end of the curve. Look, those things can happen together, and that was a recent surprise to folks when the Fed was cutting rates and the 10-year Treasury was going up, and they kept saying why. It happens. I think it's one of those things that none of us can control it, so we have to figure out where's the opportunity inside the environment. I'll pick one example. We do a lot in the self-storage sector. And the self-storage sector has been a darling of the commercial real estate industry for decades in a lot of ways. It's becoming more well-known over the last maybe 10 years. But the industry is going through some hiccups right now. There's some markets that were overbuilt. There's pressure on rents. There's pressure on occupancy. Those are realities right now. That doesn't mean it's not a good, strong, valuable property type. It doesn't mean there's not good investments in there. That's when I talk about some of us slogging through the mud in some of those deals. We're going through a couple of large storage portfolio refinances right now where we're slogging through the mud, where we're having to explain the story of what happened the last 2 years. And it's almost, I hate to say it, but I could almost record what we're going to say and press play because, that's the reality. But we're starting to see that turn. So there's pressures, but...
What I feel like is interesting is Charles, it seems like you live in the world of like rational, mechanical thinking of what will actually happen, and Thomas interfaces with the irrational processing of those that are looking at the same data as you, but might not be as rational about it, and have emotions in response. And that's the world that Tom's living in is the irrational processing of the rational data. That's an interesting differentiation that I've noticed with you two guys. So, all right, let's switch gears for a little bit. A lot of folks in this room want to know how to present themselves. All right, so I've got a deal. It's a new world. This is the emotions they're feeling, or this is the rational reality of what is. How do I present myself? What should I be expecting in terms of liquidity, net worth, track record? And let's maybe start with the equity side to have a common equity conversation. More institutional. Yeah, yes, okay. Please, Tom.
On the equity side, investors want to see depth in your organization. They want to see.
That's number one.
That's number one.
Okay, which means I got a follow-up question for you.
Two, maybe 1B, they want to see experience and success in the sector, in the space. They want to know that you've done it before, and that you have, so to speak, a deep bench inside your organization so that there is sustainability, there is ongoing in case something happens to somebody. That's just a very, very basic level. Those are fundamental things that they want to see in their operating partner.
Net worth liquidity on average?
Depends on who the investor is. Some of them put a big premium on the liquidity that the operating partner is bringing, the sponsor is bringing in. Others don't. Others don't get too hung up on it because they view themselves as they're the funding stream. They're the liquidity strength of the partnership. So lenders will take a different tack. Lenders will say, hey, I want to see, if I'm making a $100 million loan, I want to see $10 million liquidity and $100 million net worth or whatever. But as an equity investor, no, that's a whole different.
Okay, so on the equity side, if I'm sitting in this room and I'm hearing, okay, I need to have depth in an organization or a big track record, maybe I'm missing one of those things. Is that game over? No conversations in the world right now, or is that a different type of conversation?
No, that's a good question. It's not game over. It just means you better have a really well-researched and thought-out business plan for whatever you're investing in, and that will carry one of those things.
So if you can showcase rigor in your data to support your business plan, a big swath of research that kind of covers all the questions that perhaps your track record or your depth doesn't generate comfort that the questions will just be answered themselves, that can kind of fill in the gaps?
Yeah, it can
So
help
quality homework.
It can help fill in the gaps, and there will be. Okay, how's this going to get executed? Again, it depends on property types and things like that. I mentioned self-storage earlier, so I'll use that as the analogy here. Look, somebody can buy a single asset or a portfolio storage assets and have all the research and everything else and line it up and say, I'm going to hire Extra Space as my third-party property manager. Check, no problem. I got the largest self-storage owner in the world who's going to be managing this property. I'm okay.
Okay, right on. So what I'm hearing is, if you're missing one of those things, go mystery shopping, go door knocking, get more data than anybody else that you know, and become an expert so that you can have a smart answer to any question that could be asked of you. All right, I'm going to switch gears again. Charles, I want to talk about what exactly is Vontive, how are you changing the game with it, and what will happen to the single-family space as a result of this type of business plan that you're executing?
So we focus on investment real estate, but as I mentioned before, like 1 to 4 unit residential, small balance, multifamily. So like our loans typically are hundreds of thousands of dollars to a few $1 million, not $100 million. So the best analogy I could give you on our business is, imagine if you're going to get a loan, you go talk to your bank or you talk to your mortgage company, over the phone or in an office. They have you fill out some paperwork, they do some underwriting, there's a lot of back and forth, you get approved, you sign loan documents, and then the loan goes into servicing and you drop off a check every month or you mail a check in, and it's all very manual. We're doing all of that through software.
And that kind of, it blew my mind that wasn't already happening, which is like, that's just not already happening.
It is not already happening, shockingly.
Yeah.
And we can spend more than 5 minutes on why, but we're doing that, and we're doing it with the same. I would argue with a stronger level of underwriting and of risk management through the life of loans than you get if you're working with like a Berkadia on a multifamily loan or with like a Wells Fargo on a conventional loan or whatever. Because again, it's the processes are manual and the data underlying it is unstructured. So that's what we're doing. And then as part of that, really we view our customer as the capital markets. And so, and we face off with like Blackstone, we face off with Citi, we faced off with Barclays in the past, we face off with Prudential, a number of folks that are household names in the credit space. And what we're doing with the technology is reducing barriers for them to come in and allocate capital. Like if you're a single family investor, or maybe you were and you graduated to being a GP or doing multifamily stuff, you'll remember the days of going to your local hard money lender and paying a credit card APR for, the privilege to put 25% down on a house and pay for your own renovations. And that's because the hard money lenders would close fast because you needed it, but they had limited capital. So we're reducing those barriers so you can go through like a lender we enable, so we're like this financial infrastructure. You can go through a lender we enable, still close in 4 days, but we are writing loans in the 8s and 9%, so not far above prime. So that's kind of what we're doing.
Okay, awesome. Well, I think that's very interesting on the single family side. I know a lot of folks would be curious on how that shifts multifamily, but I'm assuming that you don't want to speak to that, the dynamics in the single family.
I mean, I can speak to
Yeah? Okay.
I can speak to multifamily as an owner operator.
Okay.
I think multifamily will go through a similar transition over time. I think it will be slow because you don't have necessarily universal doc sets or underwriting. It all depends on the investor. But I think eventually it'll happen through just how lenders are tooling themselves and whatnot. I think AI has potential here to really up the underwriting sophistication. Enabling humans to do more with less time and more information in front of them. And I think in the single family space, again, it's really what we're focusing on. One is standardization, and then two, likewise, just having a much better insight, much better intelligence about when a loan will fail, when somebody's not going to perform.
Okay, awesome. Every time I talk to you, I learn a little bit more about the platform, and I still don't have it 100%, but I love learning about it. So Tom, you are my favorite capital advisor I probably have ever interfaced with. I love how you have the answers to what's going on in the space, but you also understand the humans, and you focused on the storage and industrial industry for the last however many years, but you're expanding to multifamily, retail, office, industrial. If I'm sitting in the audience and you're the type of person that I'd want to interact with or work with, where should I be at in my career to come approach you after this?
You should have some deals under your belt. Most of our clients, vast majority of our clients, have institutional partners. So they've built an infrastructure, they've built an organization, and whether they're in small bay industrial, whether multifamily, whether they're in self-storage, whether going back in time they're in retail or office, they have some, even if it's a boutique size firm, even if they're very entrepreneurial, they have some successes under their belt. They don't necessarily have to have institutional partners. They just happen to, a lot of them have that. But that level of experience, and I'll use the word sophistication, but what I really mean is experience.
Okay.
And that's where we can bring some value to our clients.
All right. Everybody here's got experience, right? all the hands up, right? If you're in this room, I'm confident that you've done something with someone. You've got experience. All right, last question for both of you. For your specific asset classes that you focus on, what's the number one underwriting mistake that you see when trying to interface with capital in the capital stack? Should be presumably a different answer because of your different focus points.
I would say it echoes a lot of what Tom said earlier. It's loans fail because of lack of liquidity. And
in the deal or with the sponsor?
With the sponsor.
Okay.
And that starts with something in the deal going wrong. I think it's fundamentally why things fail.
So too thin working capital line item on the S&U.
Yeah, not enough cash on hand to basically fund your way out of a problem.
Mm-hmm. Okay.
Since Charles went the route of the sponsor and liquidity, I'll go into the real estate and I'll say the most common mistake we see made is an insistence, I'll use that word, an insistence that rents are going to grow 3% per year, and that's how this model works, and expenses are going to grow 2%, by the way, in this model, and we all know it never, ever works that way.
So what should that underwriting look
there
like?
needs to be a lot more thought. That's what really...
There's no right answer.
There's no right answer.
It's
circumstantially driven, but it's got to be thoughtful. We see, there was somebody earlier today who was talking about the insurance industry. Look, underwriting commercial real estate you know what's happened in the insurance line item cost has exploded. Okay, well, guess what? Your 3% rent growth just went out the window like that. So it's thinking about things like that, and especially on the rent side of the equation. Yeah. When you're trying to say, hey, my property's renting at X dollars per square foot and I'm going to 2X, you better have a lot of backup for how you're getting to 2X. First, and then second, what's the journey to getting to 2X? Because it's probably not happening overnight.
So. Thomas Sherlock, CEO of Talinvest, Charles McKinney, CEO of Vontiv. Round of applause to these two gentlemen. Thank you guys so much for being here. Appreciate your time, appreciate your perspective and your wisdom. Both of these folks will be in the Q&A room in 20 minutes in the meeting spot right behind us. Thank you again.